All right, let's talk about something that's absolutely essential if you're interested in the markets: candlestick charts. Our goal today is simple. We're going to take these things from a confusing jumble of red and green bars and turn them into a story that you can actually read. Let's get right into it. Okay, let's be honest. Have you ever looked at a chart like this and your eyes just kind of glaze over? It can feel like you're trying to read a completely foreign language. But here's the good news. It's a language with a really simple alphabet. And once you learn it, the whole picture just clicks into place. And that is exactly what we are going to do. I want you to think of every single candlestick as a word. Each one tells a tiny story about the tug of war between buyers and sellers during a specific slice of time. Our job is to learn how to read those words. So let's start by putting just one single candle under the microscope. Believe it or not, every candlestick, no matter its shape or size, is built from just 4 key pieces of information. If you can get a handle on these 4 points, you understand the very core of how these charts work. First up, you've got the main, thick, rectangular part. This is called the real body. It's the most important piece of the puzzle. It shows you the distance the price traveled from where trading opened for that period to where it closed. This is the heart of the day's action. And what about those thin lines you see sticking out from the top and bottom? Well, those are called wicks or sometimes shadows. Think of them as showing the full extremes of the price. The very tip of that top wick, that's the absolute highest price the stock hit. And the bottom of the lower wick, you got it, the absolute lowest price. Now, this is probably the most crucial part: the color. It's incredibly simple, but so powerful. If the candle is green, that's bullish. It just means the price closed higher than where it opened. So the open is at the bottom of the body and the close is at the top. If it's red, that's bearish. The price closed lower than where it started. In this case, the open is at the top of the body and the close is at the bottom. Seriously, just remember this. Green means up, red means down. That's half the battle right there. Okay, so we've got the basic anatomy down. Now, let's dive into the next layer of the story, because a candle's appearance tells you a ton about the market's momentum. The size of that real body is a massive clue. If you see a long, large body, whether it's green or red, that shows strong momentum. There was real conviction from one side. A small body, though, suggests that momentum is fading. And then you have this really interesting one called a doji. It looks like a cross because the open and close prices were almost identical. This is a perfect picture of total indecision, a stalemate between the buyers and sellers. All right, enough theory, let's get practical. We're going to move to a real chart and see how all these little pieces come together to tell a story. We'll take a look at a couple of trading days for Apple stock. First, just a quick orientation. On any chart you see, the vertical axis running up and down is always price, and the horizontal axis running left to right is time. In our example, each one of these candles is going to represent one single day of trading. Okay, let's zero in on this big green candle from January 6th. Because it's green, we instantly know the opening price is at the bottom of the body. That was $126.05. The price then powered up to close at the top of the body at $129.61. But look at the wicks. During the day, it hit a low of $124.90 and a high of $130.30. This candle tells the story of a very strong day for buyers. Now let's compare that to a bearish red day a few days earlier on January 3rd. Since it's red, we know the open is at the top of the body, $130.24. From there, the price fell all the way to close at the bottom at $125.13. You can still see the day's absolute high and low in those wicks, but the main story of the day was that powerful move downward. It's amazing how color just instantly tells you who won the day. So individual candles tell us the story of a single period, but the real magic happens when you start stringing them together. That's when they form patterns that reveal the broader market narrative, what we call the trend. An uptrend is pretty much exactly what it sounds like. It's a series of candles that keep making higher peaks and higher valleys. It kind of looks like the price is walking up a staircase. When you see this, it tells you that buyers are consistently in control. A downtrend is just the opposite. You'll see the price making a series of lower peaks and lower valleys. It's like it's tumbling down the stairs. Here, red candles tend to dominate, and it's a clear signal that sellers are pushing the price down. And then finally, you've got a sideways market. This is when the price isn't really going up or down. It's just bouncing between a consistent high point and a consistent low point. Think of it like a tennis match. It's a mix of red and green candles, and it shows that neither buyers nor sellers are in control. It's a period of indecision.
So let's recap the biggest takeaways. Number 1, every candle shows you 4 pieces of data: the open, high, low, and close. 2, green is bullish, meaning the price went up. Red is bearish, meaning it went down. 3, a large body signals strong momentum, while a small body or a doji signals weakness or indecision. And finally, when you string all these candles together, they form the overall trend. That's the whole shebang right there.
You now have the alphabet and the basic grammar of market charts. You've learned how to read the story of any single trading day and how to spot the bigger picture. So the only real question left is, now that you know the language, what stories are the charts going to tell you?